Thanks for inviting me here to talk about employee ownership trusts. I currently am chair of something called Social Capital Partners, which is a nonprofit based in Toronto. It's been around for about 20 years. The objective of Social Capital Partners is to broaden access to ownership for people who don't generally have access to ownership, and that's of things like houses and businesses is what we've been working on for the last 5 years. My background is as a small business owner. I have owned things like used good shops and veterinary practices, and in the last 7 years have shifted more towards this work in the nonprofit world. I'm not a lawyer, I'm not an accountant, so please don't take anything that I have to say all that seriously, and certainly don't follow any of this advice without talking to someone who is one of those things. But we have spent the last 5 years at Social Capital Partners working on employee ownership trusts and advocating for them. So what I'm going to do today is I'm going to spend a little bit of time talking about that journey, what employee ownership trusts are and why we think they are useful for Canada, and then spend most of the conversation about what they are and how they work and how they appeal to or can appeal to business owners in Canada. So, I'm going to do something like that. Okay, there we go. Good. So what are employee ownership trusts? So an employee ownership trust is a succession plan. Right? It is another way of selling your business. It is intended for full succession, so not a minority sale. When you hear employee ownership, you will often think of stock options or, I don't know, share purchase plans where workers can get up to kind of 10, 20% of a business. This is intended only for majority sales. When a sale occurs through an EOT, all employees become owners, not just management, but it is not a co-op. So normally when we start this, people say, okay, well, that's cool. Everyone gets to vote afterwards. I don't get that. That's weird. It is not a co-op. So the reason why employee ownership trusts have been relatively successful in other countries is because once the business transitions, it is not one person, one vote. The management structure stays the way it was, if that's how you want to play it. And like I say, it's a popular form of succession. There's only 2 other places in the world that have a version of this with tax incentives to support it, and that is the US and the UK. We'll talk more about how it's worked there. If all of that didn't seem like a very good explanation, there's more to come. So we'll keep rolling. But it is something, because of the tax incentives, that if there are business owners who are considering a succession, they should at least know that this is a new option. If you have never heard of this before, that is not surprising. It didn't exist until the end of June. In fact, even the advocacy for it is relatively new. We at Social Capital Partners put out a report in October of 2020, so about 4 years ago, that said, hey, we need to become more of a employee ownership economy here in Canada. That was the first we started talking about this as a country, and very quickly it moved into the federal government's set of ideas and interests, which is great. So it's gone relatively fast from there, and in June, and so again, nobody knows about it yet. There is an association called Employee Ownership Canada. We are desperately trying to make people aware of this right now, most of that through a new website and a campaign on LinkedIn, which again, you probably haven't seen. But anyway, and having conversations like this. So we'll talk through what this thing is and how it works. So, okay. So first, what is it in other countries? In the US, so the Canadian Employee Ownership Trust is based on versions of this in both the US and the UK. The Ministry of Finance, when designing the Canadian version, used those 2 as an example. The American one turns 50 this year. It was brought in 1974 along with their retirement legislation called ERISA, and it has grown over time to where there are now 6,500 ESOP-owned companies. They're called the ESOP in the US. ESOP-owned companies in the US, and the employees who are owners of those companies through their ESOP own $2.1 trillion in employee wealth. The examples from the States on some of these companies are really inspiring, right? So I don't know if you guys have ever been down to Florida. There's a grocery chain called Publix. If any of you know of it, it is about 85% employee owned. The original owner sold it to his workers through the ESOP back in the 80s. It is one of the largest privately held companies in the world. I think it's like 30th or 35th or something. And grocery clerks have retired from publics with $1 million in their share accounts because of this program. About 250 businesses in a year sell to their workers through an ESOP. In the US, because of some of the great outcomes, so it has been studied more in the US than anywhere else. I may be stepping on the toes of other slides I'm about to show you, but okay, we'll deal with that when we get there. Because it's been around so long, it has been really well researched in the US. So ESOP-owned companies tend to grow faster, they're more productive, they're particularly better in recessions, where because of the different incentives of the owners, they are less likely to lay people off and are stronger coming out of recessions, less likely to default on debt. And as a result of that, they get a bunch of attention from politicians and a bunch of tax incentives. So in the US, if you sell your company to an ESOP and you sell more than 30% of your company, you can defer your capital gains tax like indefinitely. Like essentially you defer it indefinitely, and then when you die, you pay no tax. The States has a very strange approach to what happens with wealth when people die. Either way, you never pay tax. And then if you are an ESOP-owned company in the US, you don't pay any corporate taxes. So there's all sorts of benefits for being employee-owned in the US. In the UK, based on this, they started an approach in 2014. It's a bit of a different structure, also called an EOT, inconveniently for us. About 2,000 companies are now EOT-owned in the UK. They're actually more popular now on an ongoing basis than the American version, about 9 times more popular. Over 350, around 350 companies are selling to EOTs in the UK every year currently, which on a per capita rate is about 9 times the rate in the US. So spectacularly successful. On the tax side in the UK, if you sell your business to an EOT, it has to be more than 50%, and you pay no capital gains tax, period. And it happens just at that time. So again, the similarities between the two outcomes, we're just now getting outcomes out of the UK, very similar to the US in terms of great outcomes for, keeps jobs local, keeps companies owned domestically, all of the things that politicians want. The outcomes are happening. So there is lots of political support across the spectrum. Democrats love this. Ronald Reagan loved this. In the UK, it was brought in under a coalition government that was led by a conservative. So broad political support in those countries, and again, tax incentives to support it because of those outcomes. Okay. I think I've mostly covered this, but these are the 4 things that we generally talk. Interestingly, so these 4 things are the ones we would talk about when we go talk to politicians. All of these things are proven that it does these things. The one that I like the best is the economic resilience piece. We've just gone through COVID, a lot of problems with small businesses as a result. A lot of those problems driven by who happened to own those things. Employee-owned companies, the majority of employee-owned companies have just a completely different set of incentives and tend to be more resilient, which we need in this country. And of course, the business succession angle, where you've heard all the stats around how many people are retiring in the next 10 years and the businesses that will be sold. This is an answer to that. What politicians tend to like the most is the fact that it stays Canadian-owned. That one was never on our initial list, but that's the thing that, of all parties, that's the thing that mattered most, which in hindsight makes sense. And I wish we had put on the slide, but I didn't want to redo the slide. So anyway, that's the slide. Okay, so what happened? On June 21st, 2024, the legislation passed here in Canada. The EOT was created to make it easier to sell to employees. The issue before, I won't get into the weeds. There was a bunch of complicated tax problems with selling to your employees through a trust. I'll explain why the trust matters in a minute. But it was just, you have to trust me that it was hard to do before because you don't want to know the actual reasons. Very boring. The rules were established to make sure that these were legitimate successions, so it wasn't like a way for an owner to get a tax incentive and then sell it off to private equity or something after that. And then the capital gains tax incentive came in. So there is currently, as of June 21st, a $10 million capital gains incentive for Canadian business owners who sell to an EOT. If you sell a business of $10 million to an EOT, you will pay no capital gains tax as of June 21st. But the problem with that incentive, which we'll get to a bit later, is it only is in place until the end of 2026. So we have a limited time horizon. That's why I'm out doing these kind of conversations. We need people to know about it soon in case there are near-term business successions so that we can prove that it's good, and so politicians will extend that tax incentive. Okay. So enough of that. How do they actually work? Because I know by this point people still don't really understand it because it actually is somewhat complicated. So the easiest way to think about it is to take this business example. So it's a business that's worth $5 million. And when I say worth, that's the fair market value. So your accountant tells you that if you were to go out and sell this to anybody, $5 million is approximately what you should get. Okay, so let's assume that's true about this company. It has 50 employees and the owner wants to sell 100% of it. So the way the transaction works is the owner says, okay, and this is the simplest way to describe it, is that I'm going to sell this business for $5 million to my employees through the EOT. The shares get transferred into this new employee ownership trust that they've created, and then the company owes the seller $5 million. That's the price of the business. And the company will pay it out of company cash flow over time. Okay, so the business has to be able to support that. We'll get into the types of businesses that are good for this, but that is the simplest version of it. To make it slightly more complicated, they might go to the Bank of Montreal, who say, you know, we're willing to loan your company $2 million. You can take that out on day one. So then the owner gets $2 million, and then once the bank is paid back their $2 million, they get the next $3 million, right, to get up to their $5 million purchase price. Does all of that make sense? Are there any questions about that before I keep rolling? Okay, we're going to say more as we go. Anyway, so that happens. Now, what does it mean that the employees own the company? So we've talked about what price gets paid. We've talked about where the money comes from. So it doesn't come from the workers. The employees themselves are not paying because, and this is the reason why it gets political support and tax incentive. It's because the outcomes are broad-based. Everyone in the company benefits from the sale, right? There are ways to sell to your workers for sure, like your management can buy out the company, and that's great, and that works. But this is not designed to do that. This is designed so that right down to the lowest paid employee, they will get some benefit out of this new corporate structure. So the trust, who now owns the shares on behalf of all of the employees of the company. And we will talk about how the employees then benefit, but it's a combination of dividends, and then if the company gets sold, they're the ones that get the benefit. How decisions get made after the transaction is also a common question. And the answer is the same way they always have, right? So let's envision in this $5 million company, the owner has already transitioned management to somebody new, right? So there's a president, whatever, who runs that company, and the owner is not involved in day-to-day operations anymore. That president continues to run the company the same way they did before, right? The difference now is instead of reporting only to the previous owner, they now report to a board who reports to a board of trustees, and we'll talk about how that works, but those trustees are there to act in the best interests of the employees, right? They have a couple decisions to make, but mostly the purpose of this thing is to keep management more or less as it was before. The reason why that's critical is if you envision like a small manufacturing firm in Canada somewhere, and you're the owner of that company, and you know that you're going to be paid out over time, you're going to be nervous if you sell that company and now it's like one person, one vote, right? You're not going to necessarily have faith that you're going to get paid out over the long term. What you want is stability, right? And this structure allows the company to remain stable. That's why it's worked in the US. That's why it's popular in the UK. You're not changing everything just to enable what is essentially a financial outcome or transfer of financial outcomes from an owner to their workers. Does that all make sense? That's how decisions get made. What influence can former owners have? Again, really important question. In Canada, there's a limit to the amount of influence the previous owners can have, but there's still an amount of it. So first of all, if they're the president, if they're running the company, they can keep running the company. There's no reason that they need to leave, right? This is a financial transaction, and if they want to stay for the 5, 6, 7 years it takes to pay themselves out, great, right? That's a win for everybody. They can also hold 40% of the shares on both the trustee board and the regular board of the company, and they can, because they're providing a loan to the company to buy the shares, they can put in the types of covenants you'd put there to make sure that your debt is secure. So there are ways for the previous owner to exert influence after they're gone to make sure that they get paid out and ensure that the legacy continues in the way that they want it to. Okay. This is like a simple version of the structure. A bunch of stuff was here and is not here. I don't know why. That's okay. So as a chart now, it is more or less useless. So we will move on. Oh, it's coming in. Oh, hang on. I didn't realize it does this. Can you keep clicking until we get to the, all right, this is good, keep going. One more? I think this is good. Okay. That's a feature I didn't know existed. This is the first time I'm giving this particular presentation. Okay, so just to kind of recap what happens, the seller transfers the stock to the employee ownership trust, okay? The employee owners are the beneficiaries of the employee ownership trust, and then there's a set of cash transactions here, okay? The seller provides, so forget the bank for a minute, let's pretend that didn't exist, let's pretend that was the last thing to arrive on this slide and it wasn't there yet. The seller then provides a loan to the company pays that loan back over time. Relatively simple structure. If there is a bank involved, the bank provides a loan to the company gives that loan to the seller as part of the purchase price, the company pays the bank back, then the company pays the seller back the remainder. Like, it's not a complicated structure. Okay, can we go to the next slide? Okay, how do employees benefit? Okay, so now that the company is owned by this employee ownership trust on behalf of employees, how do the employees benefit? And at the most basic level, what has happened is the owner has sold to the workers and not sold to some outsider, right? And that in itself has value, right? So there is a much more likely that the company will stay in their community long term, much more likely it will continue to be stable, much more likely that the company culture won't change or might even improve. Those things are, of course, super valuable to employees at companies, and those two things are true about a transaction like this, even money aside. Now there is money, so once and it doesn't need to wait till the debt is paid off, but let's assume the debt is paid off. There will be transparent formulas within the EOT on how dividends get paid to workers on excess cash. So the trustee now who governs the firm, maybe the president says to the trustee, look, we paid everyone. We have $500,000 left this year. We have no capital we want to invest in. The money's just sitting there in the bank. We'd like to pay it out to our shareholders who are the employees. There will be a formula that usually will have to do with people's wage, which will determine how that $500,000 gets distributed among the workers, right? So the most common formula in the UK is whatever your wage is divided by the total wages is the percentage you get. So someone who makes $100,000 gets twice as much as someone who gets paid $50,000. It doesn't have to be that way. It can be equal. It will all depend on how the owner chooses to set it up, but usually it's determined by wage. In Canada, there's a limit, which is great, on how much wage can be allocated. It's like 400 grand or so. So if you make $3 million, the 2.6 million doesn't count towards this. So it allows it to be, broader based in terms of its outcomes. And then if someone comes along and says, we want to buy this company, and the trustee decides this is a good idea, they will, the one real area of employee voice where they get to vote is if somebody wants to buy the company and they're asked on that. So here in this 50 employee company, they'll say, look, someone's come and offered us $10 million. Okay, we bought it for 5, someone wants to give us 10. You guys have to vote on whether or not to sell it or to keep it the way it is. If 26 of those 50 say, let's sell it, then now you've got this $10 million, right? And that $10 million gets split among the workers, right? And it gets split again by some kind of formula. Here you may see a formula that includes tenure. So if you've been there for 50 years or 40 years or whatever reasonable amount of time is, you're going to get paid more than someone who joined last year, despite what you get paid, right? So you come up with the right formulas for what you want to do as a company. But anyway, that's how the employees get paid. Yes. The owner. So the selling owner sets up the formula right at the start. Yeah, there's like a terms of the trust that happens right at the beginning. Yeah, and then the trustee is brought, I didn't say this, but the trustee is brought on and negotiates essentially with the owner on the price. So the owner can't say my $5 million company is worth $100 million and I'm just going to milk this thing for cash until whatever collapses. There's like a reasonable discussion of what the price should be. Okay, this is good. Oh, and I bet this one is going to come in slowly, isn't it? Yeah. Let's get right to the end. Okay. Okay. So just a graphical description of how the governance works. So the seller, like I said, can have up to 40% of the votes on the company board. Otherwise, you just have directors you choose. And then on the trustee board, who the company board reports to, again, the sellers can have 40%. The rule here is you need to have at least 33% employees. Okay? That can be the CEO, that can be the CFO, that can be your whatever, the controller. or it can be a shop floor worker. It just has to be an employee of the company who is one of the beneficiaries of the trustees of the trust. And so a common setup will be a 5-person trustee board, 2 reps from the previous seller, 2 reps from the employees, and an independent. It doesn't have to be that way, but that I think will be common. And then some sort of similar setup with a company board, but without a requirement for an employee to be on it. That'll make sense? Okay. Okay. So who should do this? What types of companies are appropriate? We know a lot from the US and the UK. The successful ones tend to be in mature industries, right? So it's not like high tech is not usually good for this. Strong and stable cash flows. So you're going to have to pay down a debt over time. You don't want to be like worried about that, either the owner or the EOT itself. A leadership transition is either done or identified. So we did a big deal in the US where we helped Taylor Guitars, which is, I don't know if you guys are musicians, but they're a guitar manufacturer, pretty popular. They sold to their 1,400 workers. We worked with the Healthcare of Ontario pension plan to finance that. Anyway, the 2 co-founders had spent a long time setting up a really thoughtful transition. The company's going great under new leadership that had been identified ahead of time. And 25 to 200 employees is like a range. Bigger than that, the price is often too high to make an EOT work. There's just too much debt. The company will never pay it off. Below that, it's probably more complexity than you want in a company that's like 15 people. And also clear path to debt repayment. These are the industries that we tend to see. The size, that just, is what I just said. But manufacturing, professional services, generally light manufacturing, so there's not a ton of capital that has to go in. Professional services, IT, finance, retail, wholesale. Construction is a big one in the US and the UK. I think it's going to be a really big one here. The reason why construction tends to be good for this is there's not a lot of demand from third parties. Really tough for private equity to make construction work because it's cyclical and it's hard to get debt, whatever. But really work well for this because it's people often work for construction companies for a long period of time. There's not another good exit for their owners. They care deeply about their workers. There's a real good a set of circumstances there. A couple of our biggest, 3 that I know of, maybe 4 of our biggest construction companies are employee-owned through their own mechanism before this thing existed. So PCL, Elliston, Graham, a company called Shandon, I think. All of them have a majority employee ownership through like really complicated structures that they needed to do because this didn't exist. Okay. What types of owners should consider an EOT? I'm gonna read this quote because I really like it. This is a guy in the UK who sold to an EOT, and he said, "Within our industry sector, we see so many businesses being swallowed up by larger competitors or taken over by outside investors when they reach a certain size. Invariably, the original business and the culture of that business are destroyed, broken up, diluted. The people that built the original business become a number, and the culture that created the success is forgotten." And so this guy, Nigel, was very excited when the EOT came along in the UK so he could sell his business to an EOT. I hear that. So I'm relatively connected to the US and the UK. I go to the conferences. I talk to the owners. They all say some version of this. It's so more than it being a financial transaction, which is where I focused most of this conversation, it's a legacy and emotional piece, right? It's people who deeply care about their community, deeply care about their workers, and are just worried to death they're going to sell something, and 3 years later they may be rich, but they're really going to be sad. And we've also heard from those folks who have sold to people who have done things with their business that make them sad about their legacy and hard for them to go to the shopping center and talk to the people who used to work for them. So business owners who are like that should probably at least look into this, right? Because it will check a bunch of boxes for them. They will require a degree of patience with the proceeds and the process. Like it does take a little bit. Well, it can take a little bit longer depending on how you do it. Certainly it takes longer to get paid, right? So if you want the money tomorrow to go buy whatever, not gonna work out. If you're comfortable waiting for money to be paid, then it's good. Of course, confident in the future of the company, willing to remain connected and involved if necessary, and a deep commitment to employees' communities, like I said. The last bit here, which some of it's cut off, but is really important. So EOTs are not for everyone, right? I'm not here saying every business owner should sell to an EOT. It will never be like that. Even in the UK, 10 years after they started, 6% of all transactions in the UK are sold to an EOT. 6% is a really big number, right? That's 3 or 350 companies a year. It means that 94% of people don't sell to an EOT despite the massive tax advantages of the EOT. It'll never be for everyone. But if we're successful, it will get to a big enough niche that it will protect some really cool businesses in, urban and rural areas across the country, and then grow over time as an alternative. That's okay, right? That's what it should be. It's not the answer to everything, but it's a really cool answer to a problem that will be perfect for some people and some companies. Okay, so the tax benefits. So this $10 million capital gain tax incentive is available again till December 31st, 2026. The deal just has to be done by then. None of the money needs to be paid. So if a business owner sells to their workers on December 30th, 2026, that's cool. They qualify, right? And then whenever they get paid, they get paid. So for those of you who have some familiarity with Succession, you'll know of the lifetime capital gains incentive, right? I think it's the LCGE, so incentive is not the right word, it's exemption is the word I was looking for when I wrote this, that's okay. That is now up to $1.25 million. You can use that in addition to this. So if you haven't used your lifetime capital gains exemption, essentially you have $11.25 million tax-free. If you have rolled in your spouse and your 15 children, it can go up from there. That's how people do, but anyway, that's cool. And it is the one tax incentive that cannot be clawed back by alternative minimum tax. Here I am now over my skis, and I can talk about it, but I could be wrong. Either way, it's worth talking to a tax advisor on that. They will be very excited about this. They do not like alternative minimum tax, and they will be very excited about the fact that this doesn't apply to them. So it cannot be clawed back. Now, it doesn't apply for everybody. If like a business says, I have a division that I would like to sell, they do not get the exemption. If I bought a business, I've never worked in it, and now want to sell it, I do not get the exemption. The exemption is for people who have worked in the business, right? The rule is at least 2 years at some point. So if I started a business 30 years ago, worked in it for 10 years, and have only owned it and not worked in it since, that's okay. I meet the 2-year qualification, and that also applies to spouses. So if you're married to someone and they die, and they worked in the business for 2 years or more, you still qualify for the exemption. So most individual Canadians who own businesses that they have been really involved in will qualify for the incentive, but there are rules around that worth discussing. Professional corporations don't qualify. The Canadian Ministry of Finance has a real problem with professional corporations that goes back a long way. It is fascinating to see how they react to the concept. It's not worth getting too deep into it, but it was wild. There are only 6 professional corporations identified in the Income Tax Act. So if you're an engineer who works at an engineering company, you probably think of yourself as a professional corporation. You are not a professional corporation as identified by the Income Tax Act, and you do qualify. So it's like, I'm trying to remember, it's medical doctors, accountants, lawyers, veterinarians, chiropractors, and something else. And that's it, right? So there's a list, we have it on the website somewhere, but anyway. I didn't know that either before this. Okay, other considerations for owners: find an advisor, not plural, who understands the new law. Not many people do. And we have found that some advisors' instant reaction to this is it's too complicated, it takes too long, you shouldn't do it. So the same was true in the UK. So while there's 350 sold now every year to UK, in the first 2 or 3 years it was like 15 the first year and 28 the second year and 40 the third year, and then it just kind of ramped up. There's a lot of hesitancy, understandable, on the part of the advisory community about new ideas. Unfortunately, we don't have time for that hesitancy because we only have until the end of December 2026. So we're trying to talk about the reasons why certain people are hesitant. So it does exist. Some people say, well, we're just waiting to see what the final details are. It's done. Final details are out. There's nothing more to come. It's done. EOTs are complicated, but I've sold businesses to third parties, to outsiders, to private equity. That is also really complicated, right? And it also comes with strings attached, right? I had to wait 2 years before my warranties expired before I was really comfortable that I had actually sold something, and during that time I had no control over what was happening at the business. So any of these things are complicated, but sure, there is some complexity to it, and you've got to work through that. They do have risks for sure. Like the fact that I don't get paid right away is a big risk. And owners looking at this need to really think that through. How confident are they in the cash flows of the company? How confident are they that they have the right people in place to continue it, or are they willing to stay in place to continue it? That's a super important consideration that everyone should think through when they're thinking about this. There are rules and restrictions. We've really identified some of the major ones. There are a few more, but not that many. So worth looking at. And the other thing to know is banks are interested. So the Bank of Montreal has a team dedicated to serving this market. Roynat, which is a division of Scotiabank, has a team dedicated to serving this market. Slowly, other companies will. Canadian banks tend to be really big lenders to American employee-owned companies. So Bank of Montreal is actually the third largest lender to U.S. ESOPs, with something like $7 billion in the U.S. CIBC, TD Bank, they are all lenders in the U.S., TD hopefully to companies who are not doing drug dealing. So it is possible to get loans to support these transactions. And again, EOTs are not for everyone, but will be perfect for some. Okay. I think that's all I have to say. It's playing. Maybe you can sense the emotion just without volume. But anyway, so we're at Employee Ownership Canada. We are doing a bunch of stuff to try to get the word out. This is an ad we put together. I've never been associated with an ad before, but it was really fun to do. This guy is actually the CEO of an employee-owned company called Friesens. If you guys had a yearbook, it likely was produced by either Jostens or Friesens. If it was Friesens, then good choice because it's employee-owned in Altona, Manitoba. Anyway, they were using his company to film this, and they looked at him and like, you're a better former owner than this actor that we hired, so why don't you do it? And so he did. So that's kind of fun. Anyway, that's available on LinkedIn anyway. But what we're trying to do is just spread the word so that people know that this thing exists. The ad is better with volume. And here at employeeownership.ca, we've got a ton of resources, right? So it'll help walk through, do I qualify for the tax incentive? How should I think about a loan? What are the steps in a transaction? All of those things and more will be coming that will be added to that as time goes on. It was only launched a couple weeks ago. That's my presentation. Thank you.